Thanks for joining me today, Rob. It's good to see you.
Great to see you, Rick.
Look forward to talking about your latest material, with whether it's the economic review or your monthly, and where you discuss the landscape of the investment environment, both the background of companies and what they're doing, as well as the background economy with regards to politics and other events. We're full of contradictions right now. I want to kind of get into those.
Mhm.
There are a lot of things that are pulling against each other more unusually than we usually see.
Yes.
For example, we've got politics versus profits. We
Yep.
have political disruption, in particular, the war in Iran, the
Yep.
closure of the Straits of Hormuz. We have questions about how the economy is performing with regards to huge Capex spending. But at the same time, we're seeing margin expansion, which usually doesn't occur. And of course, we have questions about active versus passive. But I want to start first with the contradiction between, as you put it, politics versus profits.
Yep.
We have Hormuz closed. At the same time, we've got increased earnings, and there's still a shutdown in the strait and shipping traffic, although there's news on that front I'm sure you'll address. How do you view this particular situation and the contradictions?
Yeah, it really is a fascinating time. I think if you went back to the beginning of the year and outlined a scenario for investors and said we're going to have this, big geopolitical event, Strait of Hormuz is going to be closed, and when it happened, people had this sort of big reaction that you might have expected them to have of, wow, this is really bad, big increase in inflation, potential energy tax on the consumer, potential for recession, et cetera. And much like we did in the time of the tariff announcement, when you and I chatted about that, we sort of took a step back and said, let's separate the political implications from the economic implications. No doubt it is a big event on the geopolitical scene. Sure. Lots of implications for relations between countries and alliances and et cetera. But from an economic point of view, it's a pretty straightforward modeling exercise. Oil off of the market. How does the market adjust to that? What type of workarounds are available? What substitutions are there? What changes? What doesn't? And when you walk through that, it's a pretty manageable backdrop. Nonetheless, it's a big event and it's in the headlines every day. And you layer against that this absolute boom in earnings. And I think for a while, investors couldn't quite figure out what to do. It was sort of, well, the geopolitics are bad, so certainly I have to be, de-risking. On the other hand, they seem to have taken the simple response and simple reaction, which is really powerful earnings. Let's follow the earnings higher. That's really what we're putting capital to work for.
Well, of course, everything is fine when earnings are up.
Yes.
But markets have a way of reacting suddenly to things, right? And you've pointed out that there are sort of three supports for the markets, as I recall. Earnings, right? Hormuz being a second, and then the earnings, the price response to earnings.
Yes.
What if only two of those three work out, or one of those three?
Right. Yeah, that's the really interesting scenario here. You have so many things in conflict in that the situation in Hormuz could get worse. It could get better. I think we all have to acknowledge that none of us really know the probability on that. I would say our base case is founded on there is a strong desire by a large number of countries and entities to get traffic moving through the strait again. So our expectation is that will happen at some point. We've modeled in 50% or more recovery by the end of summer.
And what do you make of the new announcement with regards to what the U.S. Navy will be doing in the Straits of Hormuz?
Yeah, I think all of the announcements that have come out that have been positive, our reaction has basically been, let's wait and see what happens. The main announcement that matters is when you start to get reports of traffic actually flowing through the strait, and the number moving from where it's been of this sort of 0 to 20 ships per day range to 30, 40, higher, et cetera. Once we get that, then I think we're comfortably out of the woods on the issue for the time being. But we're not there yet. I think there's been a lot of great workarounds, and at the same time, like you said, there's a lot of pressure on earnings to deliver, given where valuations are. This season has been spectacular in terms of strength of earnings and earnings growth. It's Pretty well documented on the large cap side. Small caps are getting through their reporting cycle. It's been a very powerful earnings season. There hasn't been any disruption from the geopolitical events. The consumer continues to remain mostly on track. There is some disruption with folks in terms of inflation and energy costs and things, but that's on track. And we think that profit margin story is still also very much intact. So I would say 2 out of the 3, very positive. 1 out of the 3 still an unknown, but we think there's a case to be made for resolution in the next few months.
Okay, well, let's move then to the contradiction in earnings, which
Yes.
is we're seeing massive Capex spending. At the same time, we're seeing margin and earnings expansion.
Yes.
And to that point about how strong they've been, and in fact, surprising people, it's actually been 10 consecutive quarters,
Yes.
right, of beating earnings estimates by, I think, an average of 7%.
Yes.
And yet sales are only up 1.2% over, on average,
Right.
each of those consecutive quarters. It's interesting to me that they continue to beat sell-side expectations, analyst expectations. It's a little surprising to me that the buy side hasn't arbitraged it away.
Right.
Maybe it has. And at the same time, this is happening even though there is this massive Capex boom that
Yes.
looks like it's only going to expand.
Right.
How sustainable is that?
Yeah, it's a great question. I do think it's sustainable, and I'll kind of walk through why. And I think you hit on something that really has been a fascinating trend, which is this outperformance of earnings versus expectations, while at the same time, sales have been very accurately modeled. So no one's been surprised by the sales outcomes. Everyone's been very positively surprised by the earnings outcome. And that says to me that there's something else going on there. And when we started looking into it, there's something else going on there was this spread of technology as one trend, and that's really 2 parts, AI and robotics. And a second trend, which is that we all observed how much more dynamic companies can be than folks realize. And we saw that in COVID. We saw it in response to tariffs. I
Right.
think we're seeing it again in response to Hormuz.
Yep.
Companies have learned that they can change much more quickly than perhaps investors are appreciating. And so those beats on the earnings side are very significant. I do see that continuing and spreading. So we mapped out a piece a while back on AI and it really being 3 phases. So the first is this heavy Capex and spending and building of infrastructure, data centers, chips, energy, et cetera.
Right.
Second phase is also well underway, which is all the big, quote unquote, hyperscalers and people building models. Some of those are in private companies, some in public, but that's very much well underway as well. And then the most meaningful piece of that is what we think are the benefits that accrue to the users of that technology. So all that Capex, once it's spent, somebody's using those tools and technologies. And for the most part, that access and availability and costs are making it much more usable by a broader set of companies. And so we think that profit margin gain spreads over time.
And to what extent are you attributing this to artificial intelligence as opposed to other technological enabled changes due to this Capex spending?
Yeah, can you
figure that out?
It's a really great question and very, very difficult to assess with any kind of precision. But I would say that the catalysts are really threefold, and that AI is one of them, robotics is another, and the fact that companies have gone through multiple periods of change in a short period of time is another. They've learned how to sort of reinvent and become dynamic over time.
I actually think that the robotics revolution and the use of multiple microprocessing in order to enable robotics and how that all works is underplayed versus the attention being paid to artificial intelligence.
I agree. And the AI helps reinforce the robotics as well. The robots are learning faster.
Okay,
There's more they can do.
right,
The costs have come down. You could rent robots now in manufacturing. And so that combined with this trend of wanting to, re-onshore supply chains and things, I think plays out over a long period of time and is a positive wave for a while.
One thing you noted is that 41% of, I think it was S&P 500 companies, have reduced their headcount.
Yes.
Is this real due to the efficiencies in artificial intelligence and robotics, or is this cautionary?
I think a lot of it is reversal of overhiring during the pandemic. So we lived through that bullwhip effect in the pandemic of a shutdown and then a boom, and people were rushing to address it.
And
there
partially
was
due to just massive liquidity,
yeah,
right?
exactly. Yes. And so I think there was some overhiring there. I do think there's caution in hiring. You've seen a number of very large companies talk about the desire to keep headcount flat while they expand revenues.
Right.
And I do think there they are, pushing employees to utilize AI or in some cases robotics in companies that are engaged in manufacturing and distribution. So that's something that I think is also a powerful trend that can last for some time.
Given the backdrop of contradictions I just went through
Yep.
with you, let's talk broadly about the market, which continues to perform very well based on real earnings, as you pointed out, albeit in many parts of the market at very, very high multiples,
Yes.
however you want to measure that.
Right.
Where do you see active versus passive playing out? And can you articulate what the environment favors going forward and why you see it that way?
Yeah. So if I had to boil that down into a couple of bullet points, I would put it this way. One is that you're absolutely right. There's this contradiction between very strong earnings and valuation levels that are pretty high. So they're justified in that the earnings are growing, but at the same time, it sort of reduces the margin for error and it sets the bar of expectations very high. So we've been watching really carefully to see how investors respond to company earnings that are strong. The reactions have been pretty good, but perhaps a little bit more muted than you might expect given how strong the numbers are. At the same time, when you step back and you think about, that divergence in the market between pockets that are very overvalued and places that have been neglected, we think the main thing that cuts through the noise over the next few years is really going to be found from an active management perspective and found from a focus on company management and ability to execute in this environment. And the reason why is this is a very profound period of time with all of the tools and technologies available. We think that some companies will adapt very well to that and others will not. And that cuts across industries. And so rather than just simply saying, in phase one of the AI build out that the benefits accrue to tech because they're the recipients of that Capex, well, now we're into another phase and these tools are available. And so within any given industry, even ones not directly tied to technology, there will be companies that adapt well and thrive and increase profit margins, and companies that lag and are left behind. And we think the only way to sort through that really is through active management, sound portfolio construction, and really solid bottom-up security selection.
That echoes a theme we've talked about, which is, in effect, given the changes, almost every company in industry is becoming, in effect, a software/technology company. And if they don't, they're going to have trouble making a difference. You mentioned dislocations, however. You mentioned parts of the market that are very expensive and parts that aren't. Specifically, what are those places?
Yeah, it's expensive is relative, right? Okay. So the expensive places are not surprisingly the same places they've been for the past few years. Large cap technology has, on a numbers basis, higher valuation metrics. But by and large, they're pretty justified in terms of the earnings growth there. So one thing that we've been emphasizing for a number of years is to stay balanced in that approach. Don't ignore that part of the market simply because it's expensive. It's sort of justified its expensiveness. On the other hand, there are lots of areas that have been ignored that we think where company managements are able to boost profit margins going forward, they will get a lot of attention and they're coming off a cheaper base and therefore probably have a long runway to succeed. So we're basically thinking of it as kind of having a one foot in the area that's working now and is expensive but justified for it, and 1 foot in the areas that have been a little left behind but have the potential to succeed in the future.
Great. Thank you, Rob, for that summary, and look forward to talking to you soon.
Great. Thanks a lot, Rick.